managing inflation. That's got to be top of mind for a lot of Americans who are looking at their budgets right now. What are you advising your clients?
I think on the savings, definitely we need to focus on setting a realistic budget that requires us to do some work and plan ahead. Now is a perfect time actually to download the transactions from your credit card companies on bank and take a look at your actual expenses in the past year. You may need to make some adjustments and start a new budget and revise those numbers to really show the inflated prices. And my tips for that is create a budget that's really clear what the fixed expenses are and discretionary expenses are, so that you can focus on cutting out fat on the discretionary expenses that are, for example, like leisure, entertainment, and maybe cut out some subscriptions that you don't use frequently. And I think in terms of saving is not enough, right? So we also need to make sure that we need to invest the hard-earned money and grow your money during this very turbulent times. And so I think make sure, just as the previous speaker said, make sure you manage your debt wisely, paying down as soon as possible, especially high interest rate debt, and have rainy day fund to prepare for potential recession in the next year. So I think on money and saving, that's my advice is create a new budget and stick with it and review it very often. More importantly for me to share today is definitely in terms of how you should invest your money during inflationary period. So I think for inflation, I do expect the elevated inflation to go down in the next 2 years. So that is the good news. But right now, at 7% inflation is still relatively high. So therefore, it's even more important to focus on planning ahead with an asset allocation plan. You need to plan for success. Right now, it's extremely important to really manage your emotion, because the recent performance has been very bad. As you see that, S&P 500 lost 18% and emerging market lost almost 20%. So even bond market last year lost 13%. So really caused people to think, should I be putting my money in the markets right now? And my answer is definitely, here's how you can get started. I think first, you should have asset allocation plan. Ask yourself 3 questions. One is, what are my investing objectives? And second is, when do I actually need the money? And the third one is, how much risk am I willing to take to earn that kind of return? I think if you work with a financial advisor, you can construct a portfolio that is fit for you.
So let's break some of this down, because obviously for some people who have just started perhaps reviewing their statements from last year so that they can set the stage for the budget, how should they prioritize? What should they start with first so that they know that they're in a good and stable position to start investing?
Yeah, I always tell people that as you look at your cash flow, it's really important to plan for the next 1 to 3 years of cash flow. The rainy day fund in general, I would say to have 3 to 6 months minimum enough cash in a savings account, maybe some online savings account that pays higher interest rate to pay for your living expenses in case you need to change your job. After that, and of course, the very high interest rate credit cards, definitely that needs to have a plan to pay it down. My general advice is also tell people to, at this time, postpone the major purchases like cars or homes. And I don't recommend people leasing cars in general, because the mentality would entice you to change your cars very frequently. That would also reduce your savings. So once you set aside enough money for rainy day fund, I tackle the really high interest rate with a plan and pay it off. Then don't miss the matching contribution at work. Make sure you put in something at least to catch that. And then every time you get a raise, and you should increase your retirement contribution. And also, I think you should increase your earned income by asking for a raise if you haven't received one because of high inflation.
So you sort of broken down how to trim some of your costs there. There's a question of how you grow your money. You know, certainly a lot of investors got burned in the market last year and are wondering, well, where do I put that aside? I mean, is something like a high yield savings account a better place to park your money right now, given the uncertainty in the market?
Actually, for the long-term money, that requires long-term strategies. So I do not actually recommend people to park most of their money in high-yield savings account. That is a good strategy for the short-term expenses. As I said, you know, anything you need to pay 1 to 3 years would be good in a high-yield savings account. But for the long-term goal that you don't have to touch the money for like 8 or decade, you know, from now actually lower valuations and higher yields today offer the best potential long-term return since 2010. So if you look at this, nobody knows when the bottom of the market is, right? If we are in a recession, but I must stress that it's important to continue putting money in the market and of course have a solid diversification plan. So it's not just putting in all in stock market if you're not willing to take on the risk. And so your portfolio can be diversified, including some bonds, US large companies, small company, global stock, and also some real estate. One data I want to make sure I emphasize is if you look at the data for Wilshire 5000 since 1971, after the 9 months worst return, you look at all these periods, and then look at what happened a year after that, average return is actually 12% after the 9 months worst period in the stock market. And 3-year return after that, total is 41%. So if people are thinking about, you know, I probably have at least 80% of a portfolio I don't really need to touch for a decade.
Right.
Think of this is the perfect time to put money in to have
and you
that
raise a good
additional
point.
Boost or return. Yeah.
Yes, you raise a good point. It does definitely depend on the time horizon. Unfortunately, we will have to leave it there. I know you have a lot to say, and I know a lot of viewers will probably be having some questions for you as well. A big thank you, though, to Echo Wealth Management founder and president, Echo Huang. Thank you so much.